Hi everyone, welcome to another lending update with David for July 2019. What a couple of weeks ever since election has settled. RBA has now dropped the cash rate for the second time in 2 months. So that has had a huge impact on the overall property market. For those people who have not been going to inspections, at the moment, as far as I know, the amount of people that's attending inspections is probably about twice or even 3 times prior to elections. So, definitely people's sentiment is coming back on the ground, and they want to be able to get back into the market again. And the whole point that RBA wants to drop the cash rate is to stimulate for wage growth and to increase for more people to spend money so that the economy can get into a better shape. And as a result of that, most of the banks are also starting to pass on the second cash rate cut in July as well. So what I've done is, I'm not going to go through all of them. I've basically consolidated a single spreadsheet that's got a lot of the lenders in terms of how much they are passing on. So you get to be able to see which of the lenders have passed on how much and when they'll be effective from. So that's number one. Number two is also APRA has now released and finalized their assessment reforms. What that entails is they are actually now removing the 7% cap. So beforehand, if you think of it like the existing and the new mortgages are being assessed at 7% interest rates in terms of repayments over the P&I period. What they're doing now is they are removing the 7% rate, and they are basically giving guidance of using 2.5% above the actual interest rate in order to be able to do your assessments. Now, that's not finalized from the point of banking, how banks are going to handle it. But at this point in time, it is a very exciting news because the gap that has been between 7.25 to what people are actually paying has been huge over the last couple of months. So people were unable to borrow money, and as a consequence of this credit tightening between 2016 and 2018, the property market in Australia, on average to a degree, has been going flat or trending a little bit down, in terms of Sydney and Melbourne terms. But now that the credit assessment is going to be easier, the owner-occupier should be able to borrow more, whereas the property investors will probably still be impacted to a degree, because if you think about it logically, let's say for example the owner-occupiers, so they are paying like 3.5% interest rates, you add another 2.5% buffer on top, that'll be 6%. So people could be assessed at 6% instead of 7.25. Now, for property investors, especially the ones that's on interest only for investment properties, they might still be paying about 4.5%, or the low 4s, which means they'll get assessed around the 6.5 to 7% mark. And that means this impact will probably not going to be changing too much from their serviceability. Of course, that's just my thoughts. And until banks actually release their updated calculators, and I'm hoping to be able to see them in the next couple of weeks, because I've got a number of investors that are jumping on me now to say, when are we going to see the updated calculators? Don't worry, I'm as keen as you guys are. I want to know what changes they are. And as soon as I have them, I will let everyone know what the impact is on the overall assessment capability. So there you have it. That's our lending update for the month with David. I hope you enjoyed the information that's provided today. If you got any questions or feedback that you'd like to give to me, feel free to comment below or email me at david@lendpower.com.au. Otherwise, I will see you guys again in next month's lending update with David.